Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 14th, 2025, Valentine's Day. S&P 500 currently sitting at 6122. I'm David Zarling, and I'm here with a man of summer, Ian McMillan. Lots to talk about this week.
A lot of movement, mainly upwards. Technically, S&P hitting a all-time high this morning. See if that sticks.
Yeah, see if that can hold.
But all the noise, couple big gap downs on Mondays over the last few weeks. Oh, all the worries about, what was it, DeepSeek? Notice how that's gone away.
Yep.
I haven't heard anyone talk about that for, maybe they still are. But all of the feather ruffling, and here we are, all-time highs for the S&P.
Well, and I think it's fair that for, November through first week in February here, markets move sideways. Whether you're using the S&P, whether you're using small caps, whether you're using the NASDAQ, it's been a consolidation. And what you look for as a technician is for that consolidation to break to the upside to confirm the uptrend is intact, right? If it's truly an uptrend, consolidations confirm in the direction of the trend. And we've been having an uptrend since late 2023. And here we go, and we continue on. And I find it fascinating that some of the surveys that are out there, that almost half of investors expect a correction during the next 6 months. And you have a bull bearish, investment survey showing the most bearishness we've seen since November of 2023. And we were only how many points off the all-time highs?
Oh. How about that? NASDAQ close to all-time highs.
Right. The big boys.
Continues to lead. Dow, Russell is, I don't know. Russell's so far behind on this march up the mountain that I think they just stopped waiting for him.
When you do wonder if there's ever going to be that quote unquote catch-up trade.
You do wonder.
But small caps have been having us wonder for over 2 years now on whether that was going to be the case.
Yeah, you look at the relative chart and then you say, okay, maybe something here. There's definitely been periods where the last summer, that was kind of more to the downside, but there's been this last post-election reaction. I don't know. Just never holds. And what's great is we don't have to be involved just in case it moves without us. We can just wait.
Yeah, we can wait for the chart to confirm. And what Ian's highlighting here is, for context, small caps are 7% off of their all-time highs, and something like the S&P is 26% above its 2021 highs.
The struggle is real.
Struggle is real. But there will be a day, and we'll make sure to highlight it on this podcast, small caps will gain some traction and have some alpha opportunity to it. The time's not yet here.
Mid cap's better, but not. You look like it at MDY. Kind of looks like the Dow maybe, but still lagging.
If you look at an MDY versus S&P, we're at the same level we were back in 2004.
Yeah.
And many technicians would call this an area of interest, a neckline, an area of polarity. It's an area where demand for mid caps in the past has outpaced the S&P. We did that in 2008. We did that in 2020, some response in summer of 24, but it would need to get itself together here pretty soon to confirm that's going to be the case again. Otherwise, it's going to be a large cap show ongoing.
Maybe that's okay.
Yeah, when your stars outperform, I don't necessarily think that's a bad thing.
A lot of these companies start off though. Look at a Palantir.
Right. They start off as a mid cap.
Or even, mid cap or even large cap with a lot of these IPOs. So
True.
it's like these things never even had a chance to be in the Russell 2000.
You're just saying by the time they did their initial public offering, they were
Yeah,
already
by the time they IPO, there were 200 billion, and then they go direct into some large cap index, and then we talk about, well, look how strong large caps are, and it's like, well, yeah, and I know a lot of that probably has been the whole. That's just how venture capitalism and private equity have worked over the last 20 years. It's just been cheap to hold on to these things until they are massive. If you're borrowing at 2%, you're not in a massive rush to pay back that debt.
Well, I think that's an excellent point. When you come to markets to raise capital to expand your business, for many years now, you went to the credit market first, right? That those rates, as you alluded to, pretty cheap. And then you came to the stock market last in order to raise funds. And so by the time you're at that point, you're IPOing as a more than a mid cap. And you do wonder under a new regime of rising rates, the next 40 years, if eventually that will hasten that progression.
Yeah, it would be nice. I would love to see, society changing companies come to market at $1 billion and not 200 billion, but stocks still act well. Look at your Palantirs, I don't know what Robinhood IPO'd at. I'm sure it was huge. And so many of these companies are massive brand names before the IPO now. But yeah. So to come full circle, small caps, terrible on a relative basis, not great on an absolute basis either, but trying.
And we're seeing, when you look at the start of the year, your top sectors in the U.S., communication, services, materials, financials, healthcare, energy, not necessarily risk off.
No.
And leading the materials are gold miners, metal and mining. Not too shabby.
Retail's been good.
Yep.
A lot of things now, and discretionary's got hit a little bit lately on a relative basis, mainly due to Tesla, I would argue. But yeah, that will affect XLY. But under the surface, lots and lots of things working well. You kind of see the same for industrials. There's stuff out there. Do I want to own XLI?
Well, that's because it's it's top weightings in XLI. There's some pretty bad.
What's in there?
Pretty bad charts in there. What's in your if you look at the top 10 of XLI, you have GE, which looks good, ADP, Uber, RTX, Boeing, Union Pacific, Lockheed Martin.
Boeing, yeah.
But things like Honeywell, not looking great.
Oof.
Union Pacific, and when I say not looking great, I mean on a relative basis, like they're not leading the sector higher.
Yeah.
But you have plenty of things in industrials. And I find it interesting that as strong of a start of a year that gold has had as a precious metal, copper's doing even better.
Seriously?
Yeah. Gold's up 10% year to date and copper's up 16.
Yeah, sitting here at this 480 level, $4.80.
An industrial metal like copper potentially setting up to move higher, we'll see, would be pretty significant from, if you want to call it, intermarket analysis to see that happen. And we're starting to see international strength. Poland, Sweden, Germany. Germany, the DAX, highly correlated to U.S. markets. Continues to move
out. Yeah. Very strong.
Up 3% on the week. And even places in Latin America, and we've talked about Argentina, but you've got Chile, Colombia, Brazil, Mexico. Now, many of those, though, while they're up strongly year to date, you look at Brazil priced in dollars, and it still has plenty of work to do. It's not like the opportunity is over there if that's going to actually take place. It remains in a downtrend, and this type of move would be considered counter trend in nature.
Another move needs to be discussed as I am perusing currency charts.
Okay.
US dollar index below 107.
Wow.
So again, like all charts, got to stick, but potentially getting back in this range, 100 to 107, been in it for, 2 years, basically up until this past mid-December. We know that's kind of when stocks started to go sideways, at least the major indices. We had a lot of intermediate term tops back mid-December. A lot of that was on the back of dollar breaking higher, breaking out of this range. We are retesting that, hopefully going back in that range. So we will see if that is going to be a tailwind for stocks.
I think that's a great point to bring up. I mean, since November of 22, the dollar had been in that range between 100 and 107, and the market performed very, very well. And your point being that once the trade weighted dollar got above 107, that's when we started seeing some weakness or consolidating in the market, broadly speaking, U.S. market. And if we're going to drop back into this range, is that indicative of continued equity strength? Time will tell. I mean, we know that the relationships between the dollar and markets change all the time.
So far, the market seems to like it.
Yep. Despite anybody's opinion on tariffs or DeepSeek or Doge or any of those things, turns out the market could care less about our opinions. Very hurtful, very inconsiderate to not.
Can't believe you say something like that on Valentine's Day.
Yeah. Market's not our Valentine. Market does not love us.
Will not be mine.
Will not be mine. It's the great humble pie machine. Doesn't care your certificates, your Nobel Prize winning research, your white papers, your popularity on YouTube. Market doesn't care.
Yeah. Go figure. YouTube popularity, YouTube subscribers did not lead to good returns in the stock market. I'm shocked. It's a hard game.
It is. It's the arena. It's the most competitive arena on the planet. Fresh off the Super Bowl, which we won't talk about on here because I know that's a tough topic, but we all watch professional college sports. At least most of us do. I don't want to speak for every listener, and those are hard, but I'd argue markets are the most competitive place on the planet. And you're
A lot
not
of money involved. A lot of money, a lot of egos, a lot of big fish, a lot of small fish.
And markets are not for romance. Markets are not for fun. They're not for emotional jollies. We're not in markets for entertainment. It's purely speaking, like we talk about, I think there's some probably 3-letter acronym economic release this week. If we're going to talk about inflation, I mean, really the reason why people and our clients are involved in the market is to protect their purchasing power. Let's not forget this. It's not about how entertaining it is or how right it might make us seem. It's about protecting purchasing power. So when you get in your retirement years or unproductive years, you're able to still maintain your standard of living, be able to take care of yourself healthcare wise, be able to buy food. That's why we do it. And I think sometimes that gets lost, that investing or talking about the hottest stock that's out there, that there's some entertainment value or that there's some emotional attachment. Not true. Have a process, have a plan, and it's all about protecting that purchasing power. Kind of went on a soapbox there.
No, I think it's great.
What are we seeing out of breadth?
I think it remains pretty good. Obviously, we talked about a few sectors, and I know the counter arguments and why isn't RSP outperforming or small caps or mid caps or any of this other stuff. I don't know if I have a great answer. I mean, it is what it is.
Isn't that come down to math? I mean, if you've got a cap weighted index versus an equal weighted index and you have the momentum factor in a trend, that you're going to see the big get bigger, right? Because, 10% on a $500 billion market cap is a much bigger number than 50 billion market cap.
For sure. No, I think a lot of we talk about being sideways for the last 2 months, Apple sideways, Tesla, Nvidia, a lot of these bigger names. Gosh, I haven't looked at a Microsoft chart. That thing's been sideways for a year. Can you believe that? Microsoft sideways for a year.
Well, and last week, Kevin and I highlighted that Microsoft versus S&P, same spot it was in July of 2020.
Hmm.
I mean, that's going on 5 years of 0% alpha from one of the all-stars of the S&P 500. I can
Apple
see why.
recovery
Yep.
went down to its 200-day, back above that 238 level. So we will try this again.
Well, and energy continues to struggle. That's one of the lowest weightings in the S&P.
Yeah, I mean, right, and crude itself, downward slipping 200-day.
And
Barrel.
you think about a new president, and you think, okay, I'll give you the choice of investing in solar versus coal. Guess what? Coal's down 16% year to date.
What's solar doing?
Solar's up about 3.
Okay.
Ethanol's up about 7, more than gasoline. So your potential market narratives that you might build around your political view might want to check that at the door when you get involved in a market, because markets are a future discounting mechanism. What do you think about gold miners and gold?
I don't know, man. I mean, strong move, golly. And I don't know how many times I've seen people post this gold chart. And it does. It's a great chart. I get it. Gold's up and to the right, very strong. I don't know. And like the relative, like we're back above a relative 200-day now on the gold miners, but it's a gross, sloppy. And I still, gold's up. I don't know how much since it broke out above, what was it, like 2,100? Is that kind of one of the areas? Yeah, $2,100 last February. We're sitting at $2,900. That's 40%. It's a good run. Has outperformed the S&P a little bit. It has since if you want to snap that chalk line, January 1st, 2024. I'm just still not really feeling it yet.
Well, I think it has to do with the relative.
It does.
performance.
Yeah, it's the relative.
If you're looking at, let's just use gold futures versus S&P futures, we're sitting at a really important level near 0.5 in that relationship. And it needs to clear that for it to confirm alpha versus S&P.
Hasn't outperformed SSO.
No, it hasn't.
There's not 2x gold. I'm sure there is, and gold miners and all that. But yeah. And I mean, it's been strong, right? Strong dollar. Gold's still been strong. Gold around the world. Strong dollar, right? That obviously kind of is a tailwind. Gold denominated in other currencies. So weak dollar, gold. I mean, we got gold. We have the dollar getting hit. Gold getting hit. So it'll be interesting if like a weak dollar leads to weak gold because, I don't know, rising rate. But I don't know. Maybe it keeps going up. I'm not stressing.
No.
I'm not pulling my hair out, hoping clients don't email me asking why we don't own gold.
Yeah,
I mean, I can give you the phone number to Roslyn Capital.
There's definitely a pretty clear line in the sand here near 0.05 for gold versus S&P that can be used, and we'll be happy to participate for sure if that becomes the case.
That'd be neat.
How about crypto?
Bitcoin's hanging out for now, still in the range. Really haven't moved much. I mean, Bitcoin hasn't moved much in all of February.
Well, and even going back to November of 24, November of last year, we're going on 4 months of nowhere for Bitcoin. That's a pretty solid consolidation considering what it did before then. And we're getting an expansion in tools to participate in crypto, it appears.
Yes. Hopefully some coin, Solana. I think Ripple's trying to get an ETF.
Yep.
Can't tell you their utility. I don't know. There's a lot of stocks that I can't tell you their utility. So kind of a moot point with me.
Oh, it's like Palantir. Can anybody really tell you what they do?
No, but it's liquid. I can get in and out of it. I could look at the chart. So that works.
Because I would argue even the fundamental analysts don't know what Palantir does, which would make sense considering their heavy involvement with government contracts and the Department of Defense. I mean, probably shouldn't know everything that they are capable of doing.
What about Apple? I don't know what AppLovin does. They make things like platforms for apps.
They love apps. And I assume it's not like what you have before the main entree. I'm assuming it's not fried cheese sticks. And
what if that really was it? They make the best jalapeno poppers, and that's why they're up 9,000%.
Could be. I suppose it would match, when you look across the board on, hey, how's the U.S. consumer doing? I mean, I know you can look at some fundamental reports on retail sales, but you could also look at how cruise lines are doing, how some travel spots are doing, how a lot of the discretionary spending,
hotels,
credit cards are doing.
We were talking about, and then anything vacation related, including, I talked about it yesterday during market call, like the bookings and the Expedias and all those things that touch people going places for pleasure.
Consumer seems to be just fine. And I get it. There's always going to be a government report that points to the contrary. I totally get that. Like whether it's on credit cards or delinquency on car payments or retail sales.
Well, and of course, a lot of times when they bring this stuff up, credit card debt, they'll use nominal figure. So, the U.S. hit an all-time high in outstanding credit card debt. Well, yeah. I mean, there's just more. I would assume there's more credit card debt than there was in 1993. There's a lot more money out there and a lot more people.
But yeah, there is a lot more people and a lot more people in their earning years.
And things cost more. You're putting a TV on the credit card. TV's a bad example. TV's actually, given their technological advances, gotten pretty cheap over the last 20 years. Yep. But you put a computer on the credit card. It's $2,000? 1990. Well, maybe that was also a bad example. Computers are pretty expensive, but whatever it was, things just cost more. Grocery bill costs more. So it's kind of like more. Also like, they do it a lot in the market, like outstanding, total assets of people shorting the S&P or, there's $50 trillion in S&P puts now. Well, yeah, of course that's more than it was 20 years ago. And in 2045, it's going to be even way bigger than it is now.
Because there's going to be more people and inflation is real.
And the S&P is going to be at like 15,000 and it's just the way it works. Big numbers get bigger.
Math. There's definitely not enough attention given to the demographic piece of this. And I get it. Like I'm a firm believer you got to have a positive birth rate. You got to be above replacement rate. It's a good thing for society. And I know we don't have that right now, but we do have a growing population. And the more people there are, it's demand for products that have less supply. So yes, there will be some inflationary. And again, that's why we're involved in markets, not for the fun of it, but for protecting purchasing power. I don't know why people don't pay attention more to the demographic piece.
As far as the economy?
Yeah, just there's more people. That means more consumers, more producers.
Yeah, more people that have a credit card in their wallet.
Yeah, more people traveling. And there's still going to be cycles. There's still going to be the housing cycle. You're still going to have booms and busts, whether we're talking about a new technology like artificial intelligence, it's going to be a boom and a bust. That's absolutely going to happen. But this population wave that we're in right now, and that's your generation, Ian, reaching into their peak earning years, family formation.
You're all on the credit card.
Get those points and cash back.
I am not. I could be better with the points. I know a couple people that are really good with the credit card points, but I don't know if I'm disciplined enough.
My wife is a maestro.
She's good.
Oh yeah, we get a pretty nice cash back. They put it on there, pay it off every time. build up that cash, get a check every year. She does a pretty good job.
They send you a check like at the end of the year.
Yep. We'll use it to this year for an excursion with the kids during spring break. It'll be good. I know we've kind of dovetailed off here on some fundamental things, but I think it's because in some sense, the market remains with the same characteristics that it's had the past few weeks to couple months here, where we've had a breath reset. We have bullish percent in the 50s. We're not sitting here up in the 80s and 90s, which is when you need to sit up and pay attention and say, okay.
Yeah, you're right. Bullish percent. What we look at earlier this week, it's like a 51.
Mm-hmm.
Yeah, so you're not screaming. We've gone sideways for 2 months after a healthy post-election rally.
And we held that gap from the election. Like there's some auctioning processes that are going on here where you're checking out if the buyers from the election are real.
We did all this without mega caps.
Right. And some will point to, hey, there's only 40 or 50% of stocks above their 200-day moving average. There's 2 ways to look at that. Is that a divergence? Yes. But is that also a reset point? Is this where you start to see it broadening out? Because you're seeing it broadening out in international.
We are seeing that. And I don't know. I kind of put international up there with gold. Like it acts like it wants to be serious. And then of course you do get these areas. I mean, you mentioned Argentina's been strong. Israel's been strong. You mentioned the DAX earlier. Yeah. We'll see. China, still kind of waiting on China. Having a good day today.
And European financials are points away from recording the brand new all-time high that we haven't seen since 2014. And they could rug pull it. They could act like they could sell it here. Not here to tell the market what to do, but how bullish and productive would that be if we're seeing European financials go out to their highest levels ever? You got the DAX moving out continuously to new all-time highs. You've got the Nikkei and its 19 highs, wonderful consolidation. And if that moves higher, there's just a lot of characteristics supporting the weight of an evidence of an uptrend. And I get it. What you have to combine a couple time frames here. I understand that the following weeks to end February, seasonality speaking, extremely negative. Like
yes,
this upcoming 2-week period, next week and the following week, worst weeks in a 6-month period of November through April. Do we pull back during that? Could absolutely happen, but wouldn't negate the uptrend necessarily. And I will say, we're, if you want to say long in the tooth, since we've tested the 200-day moving average on something like the S&P or even the NASDAQ.
Yeah.
It's the second longest period of time of not testing the 200-day on the NASDAQ.
We haven't been in the S&P since what was that, November 23?
Yeah, November of 2023.
Dipped below for a week or so. Jumped right back above. We're off to the races. Barely even been below a 100-day moving average in that time period. We've been down there for about 4 days total. A little bit last August and then the day in January.
No, I get it. And since we're bumping up towards the end of our time, I always like to highlight the supporter of this podcast, the Adaptive Select ETF listed on the New York Stock Exchange under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal, distributed by Quasar Distributors, LLC. So before we wrap up and ask people to give us a high ranking, anything else you want to highlight before we close it down?
Trend remains healthy. We talked about these Monday morning gap downs over the last month or so. They are definitely painful. You're sitting on Sunday night, but they immediately get bought up. So I think that also speaks, as gross as they are Monday morning, at the open, by Friday, it gets scooped up.
Right. And the
So
good news is no gap down on Monday, President's Day.
that's true. Thank you to our presidents.
Yep. So if it's going to be a gap down, it's going to be Tuesday. But your point is valid. You see these gaps down. They've been bought up the last 3 weeks, on the verge of clearing new all-time highs. We have a while to go to close. It feels like the last few recordings we've said that, and the market sold off in the afternoon going into the weekend. We'll see if that's the case this week. It would be a character change if it did not.
That would be nice.
It would be nice. But I appreciate you being back on here. I know you're in a week of mourning over the Chiefs,
Ugh,
but I appreciate you doing this.
Like,
Hey, you got to be in the game to lose the game. So at least they were in the game. But it's a lot like markets. It's no fun to lose big. Rather lose small. So I get it. But at least you're in it. At least you're in the game.
yes.
But I appreciate you being back on here. To everyone listening, we hope you enjoy this. Share with your friends. Give us a high ranking. It means a lot to us. Thank you.
Have a great weekend, everyone.